Good
Good
morning,
morning.
sir.
Sir.
Sorry for coming late. So, this morning we shall be looking at taxation of partnership, otherwise called partnership assessment. That is what we are looking at this morning. So, taxation of partnership, otherwise called partnership assessment. So, we start with what is partnership? Partnership. What is partnership? Partnership is a relationship between two or more persons, a business relationship between two or more persons carrying on a business with a view of what? Making profits. A business relationship or association between two or more persons carrying on a business with a view of what? Making profits. That is what? Partnership. So we have what is called partnership deed. In a partnership, partner A, partner B, partner C, they come together to form a business. The business name can be ABC and Co. ABC and Co. That is a partnership business. So coming together of two or more persons carrying on a business with a view of making profits is partnership. So we also have partnership deed. What do we understand by partnership deed? Partnership deed is a document that contains relationship or agreement between what? Between two or more persons. It contains relationship, the agreement that will guide the conduct of the partnership business. Partnership deed is a document that contains the rule and regulation that guide the conduct of the partnership business, that regulates how the partnership business is going to be carrying on. It's a document that guides, that states the rule and regulation, the terms and conditions guiding the partnership business. At the formation of a partnership business, there have to be draft of partnership deed that all the partner is going to be signed by the partner. It will tell them the terms and conditions, the rule and regulation guiding the partnership business. So this partnership deed has some content. What are the content of partnership deed? The amount of capital to be contributed by each partner is part of the content of partnership deed. The rate of interest on capital is also part of the content of what? Partnership deed. The partnership salary, the salary paid to any partner, is also part of the partnership deed. The rate of interest on loan is also what? Part of the partnership deed. Profit and loss sharing ratio, the basis of sharing the basis of profit and loss sharing ratio is also part of what? Part of the partnership deed. The rate of interest on drawing is also part of the partnership deed. The method of admission of new partner is also part of the partnership deed. All these are the content of partnership deed. Now, aside from that, when you want to form a partnership business and the partner fail to have a partnership deed, there is no partnership deed. That means they did not sign an agreement at the beginning of the partnership business. They don't have partnership deed. Partnership Act of 1890, we are going to use it in a situation where the partnership business does not have a partnership deed. Partnership Act of 1890, we arise. What is Partnership Act of 1890 saying? What is Partnership Act of 1890 saying? The Partnership Act of 1890 is saying that the amount of capital to be contributed by the partner must be equal. That means each partner is to contribute same amount of capital. Each partner is to contribute what? Same amount of capital. That is one of the contents of Partnership Act of 1890. No salary to any active partner. That means no partner shall be entitled to salary. There will be no salary to any partner. It is stated in the Partnership Act of 1890. And likewise too, the profit and loss sharing ratio must be equal. So what that one means is the profit and loss sharing ratio of the partner must be equal. That is stated in the Partnership Act of 1890. Another one too, the rate of interest on loan should be 5%. If any partners give the partnership business a loan, the rate of interest should be what? 5%. When we don't have partnership deed, like I said, Partnership Act of 1890 will arise. In the absence of partnership deed, Partnership Act of 1890 will arise. So that is that. Now, relevant tax authority. Taxation of partnership or partnership assessment. Who are the relevant tax authority? The relevant tax authority is the State Board of Internal Revenue, where the partners, where each of the partners reside. The State Board of Internal Revenue, where each of the partners reside. As we all know, the partnership business is not assessed to tax. Rather, it is the profit derived by each of the partner, the profit share to each of the partner from the partnership business that will be assessed to tax. The profit shares to each of the partner from the partnership business. That is what is going to be assessed to tax. The partnership business itself is not assessed to tax. It is the profit of the partner from each of the partnership business that will be assessed to tax. So, partnership business, they are due for personal income tax. It is personal income tax the partners will pay from their share of profit given to them by the partnership business. Now, the next thing is computation of income of a partnership business. How do we compute the income of a partnership business? How do we compute the income of the partnership business? Under this, if we want to compute the income of the partnership business, that means we want to compute the adjusted profit. We want to compute the adjusted profit. If we want to compute the adjusted profit, from the net profit, you are going to add back the salable expenses. From the net profit, you will add back the salable expenses. When you add back the salable expenses, you can less your non-taxable income. So you will get your adjusted profit. It is the adjusted profit that will be shared by each of the partners based on the profit sharing ratio. The adjusted profit will be shared by each of the partners based on what? On the profit sharing ratio. So each of the partner will share the adjusted profit based on the profit what sharing ratio. And while computing the adjusted profit of the partnership business, net profit, you add back disallowable expenses. All the disallowable expenses is added. Partner salary, interest on capital, interest on loan is not disallowable. It's allowable expenses. You don't need to add it back. It's allowed. It's an allowable expenses. You don't need to add it back. Now, the next thing is, let's look at taxable income of a partner. What are the income of a partner if any of the partner earn the income? What are those income that will be assessed to tax? What are the income of a partner that will be assessed to tax? It is called taxable income of a partner. One of the taxable income of a partner, like we all know, is called interest on capital. Interest on what? On capital. If any of the capital contributed by each of the partner, the partnership business is going to be paying interest to each of the partner on that capital contributed every year. That interest paid to the partner is an income to the partner. It's an income to the partners. Each of the partner will receive interest on capital from the partnership business. It's an income to them, but it's an expenses to the partnership business. It's an expenses to the partnership business, and it's an income to the partners. Another one, leave passage. Leave passage, if any of the partner receive a leave passage, it's an income to the partner. It's an expenses to the partnership business. Second, salary of a partner. Any of the partner, there may be some active partner that will be receiving salary. So in the expenses of the partnership business, you will see it as an expenses and it's allowed. But to the partners, it's an income to them. Like I said, the partnership business is not assessed to tax. Rather, it is the partner, each of the partner, A, that B, partner A, partner B, partner C, that will be assessed to tax, and they are going to pay personal income tax. Share of profit or loss. Share of what? Profit or loss. Share of profit or loss. The share of profit or loss too is an income to the partner. After you have deduct all the expenses from the turnover of the partnership business, the remaining profit, you convert it to adjusted profit. That adjusted profit is going to be shared by the partners. It's an income to the partners. Likewise too, interest on loan. Interest on loan too. This interest on loan is an expenses to the partnership business and it's an income to the partners. Interest on loan is an expense in the partnership business and it's an income to the partners. Now, let's look at treatment of partnership loss. When you want to compute the adjusted profit of the partnership business, you now get adjusted loss. How do we treat it? The adjusted loss too is going to be shared among the partners. It's going to be shared among the partner. And when the adjusted loss is shared among the partner, there will be what is called carry forward loss relief. If in the future there is a profit, before you assess the profit to tax, that loss will be relieved against the profit before you can assess the profit to tax. So loss from the partnership business is going to be shared among the partner based on the profit sharing ratio. And that loss, each of the partner can carry it forward, and they can carry it forward against any future profit. If there is any future profit, any profit in the future year, we have to relieve the loss before assessing the profit to tax. So that is treatment of a partnership loss. Partnership loss. Now, let's look at treatment under changes in partnership. Treatment under changes in partnership. What are the treatment under changes in partnership? There can be changes in partnership. What are the changes in partnership? If there is admission of a new partner, that means there is changes in partnership. If there is retirement or resignation of one partner, that means there is changes in partnership. If there is a conversion of partnership business to limited liability company, that means there is changes in partnership. If there is a changes in partnership, what are the treatment? How do we treat it? First, we need to look at admission of a partner. Admission of a partner. Admission of what? A partner. When a new partner is admitted, when what? A new partner is admitted, what is the treatment? What is the treatment? When a new partner is admitted, what is the treatment? When a new partner is admitted, the new partner admitted, we are going to apply commencement rule for that new partner in assessing the partner that was just admitted to tax. Commencement rule we apply. Secondly, when the partner that was just admitted from that partner that was just admitted, if we are told, resigned from another partnership business before joining a new partnership business, no commencement rule we apply. But if a new partner, he has not been into any partnership business before and was just admitted, commencement rule we apply. Another one, retirement of a partner. Retirement of a partner. If peradventure one partner retire or death, one partner death, one partner just die, what is the treatment? That partner that retire or sudden death, cessation rule will apply to that partner. That partner that retire or sudden death, cessation rule will apply to the partner. But if we are told that a partner want to retire or resign to join another partnership business, cessation rule will not apply to that affected partner. If you want to, maybe you are in a partner ABC and Co. You want to retire from that partner ABC and Co. and you want to join another partnership business. That new partnership business you want to join, cessation rule will not apply to you in ABC. So that is on retirement of a partner. Now, amalgamation of a partnership. Amalgamation of a partnership. How do we amalgamate? Amalgamation of a partnership. What is amalgamation of a partnership? When partner A, B, C, and Co. is a partnership business, they now amalgamate, they join, meaning join together with another partnership business called XYZ and Co. A, B, C, and Co. amalgamate or join with another partnership business called XYZ and Co. How do we treat that? In the case of amalgamation of a partnership, commencement rule or cessation rule will not apply. Commencement rule or cessation rule will not apply. And when there is amalgamation, the qualified capital expenditure will be transferred to the new business, to the new partnership business at the tax written down value. When there is amalgamation, the qualified capital expenditure will be transferred to the new partnership business at the what? At the tax written down value. That is on amalgamation. Now, the next changes we need to look at, changes in treatment of changes of partnership business we need to look at is called conversion of a partnership business to limited liability company. Conversion of a partnership business to what? To limited liability company. What is the treatment of a conversion of a partnership business to limited liability company? How do we treat conversion of a partnership business to limited liability company? What is the treatment? Number one, A, B, C, and Co. is a partnership business. They want to convert to a limited liability company. If they convert to a limited liability company, their name will now be ABC Limited. That means they are now a company. What is the tax implication of that conversion? What is the tax implication of the conversion? ABC Limited want to convert to ABC and Co. Want to convert to ABC Limited. What is the tax implication? Number one, the tax implication of conversion of partnership business to limited liability company. Number one of them is cessation rule is going to apply to the partnership business. Cessation rule will apply to what? To the partnership business. And profit arising from cessation shall be based on what? Personal income tax. Cessation rule will apply to the partnership business, and profit arising from cessation will be based on what? On personal income tax.
How about the terminal profit, sir? From the business.
Yes, that terminal profit, we are going to apply cessation rule to it. And that terminal profit will be subjected to personal income tax. That is what we are saying. Cessation rule will apply to the partnership business, and profits arising from the cessation shall be based on what? Personal income tax. That cessation rule that apply to that partnership business, that means the profit of that partnership business is now a terminal what? A terminal profit, and is going to be subjected to personal income tax.
Like my question, after the the company na cease operation, maybe the debtors of the company, if they paid afterward, and after
What do you
they've
say?
shared, after the profit of the partnership business has been shared, when cessation reapplied, and but there are still
Mm.
people that are owing the company.
There are still people that is owing.
Maybe there are still people that are owing the company, the partnership business, sorry, and the company has been shared, and okay, this new limited liability company has now start operation. So you understand? So how will they now share those profit that will come later? Maybe those debtors profit, and if there is expenses to incur, I mean to get the profits too, will they
Any
still share
profit
it
that
back to the?
come after 6 months of cessation is going to be still shared by the partnership, by the partner. Any profit that come after 6 months from cessation will still be shared by the partners. Do you understand?
Okay, sir.
Yes. The next one, commencement rule, we apply to the new limited company. Commencement rule, we apply to the new what? Limited company. And profit arising from the commencement in that new company, the profit that arise from the commencement is going to be subject to what? Is going to be subjected to company income tax and education tax. Commencement rule, we apply to the new limited company, and profit arising from the commencement is going to be subject to what? Company income tax and education tax. That ABC Limited, after ABC and Co have been converted to ABC Limited, that profit that arise in their first year, we are going to apply commencement rule to it. And the profit will be subjected to now company income tax and education tax, because they are no more a partnership business. They are now a limited company. They will be paying company income tax and education tax. They will not be paying personal income tax again. Another one, incorporation expenses incur. Incorporation expenses incur shall be applicable on the new limited company and is going to be treated as a disallowable expenses. That means preliminary expenses incur, called the incorporation expenses of converting the partnership business to limited liability company. That preliminary expenses incur of converting the partnership business to limited liability company is treated as preliminary expenses, and we are going to treat it as disallowable expenses. It's not allowed for tax purpose. It's not going to be allowed for tax purpose. It's going to be disallowed. Another one, the new limited company will be required to register with Federal Inland Revenue Service. The new limited company will be required to register with who? Federal Inland Revenue Service. And for what purpose? For VAT and CIT purpose. Within 6 months from the date of commencement of business, the new limited company will be required to register with who? Federal Inland Revenue Service for VIT and CIT purpose within 6 months from the date of what? Commencement of business. Another one. Professional fee paid in respect of the conversion. We attract withholding tax and value-added tax. Professional fee paid in respect of the conversion. We attract withholding tax of 5% and value-added tax of what? 7.5%. Professional fee paid in respect of the conversion. We attract withholding tax of 5% and value-added tax of what? 7.5%. So professional fee paid in respect of the conversion, we attract what? Withholding tax of 7.5, withholding tax of 5% and value-added tax of 7.5%. Another tax implication. Another tax implication is the capital of the partner will be converted to ordinary share capital. The capital of the partner will be converted to what? Ordinary share capital. And stamp duty payment. Stamp duty will be paid on the shares. The capital of the partner will be converted to what? Ordinary share capital. And stamp duty will be paid on the shares. The capital of the partner will be converted to ordinary share capital and stamp duty will be paid on the shares. Another one, the qualified capital expenditures will be taken over by the limited company at the tax written down value. The qualified capital expenditure will be taken over by the limited company at the tax written down value. And only annual allowance will be claimed on the remaining lifespan. And only annual allowance will be claimed on the what? On the remaining lifespan. We have looked at the changes. Number one changes we are talking about, admission of a new partner. Number two, retirement of a partner. Number three, amalgamation of a partner, of a partnership. Number four, conversion of a partnership business to limited liability company. Number five is when there is no changes, going concern partner, how do we treat it? That means we are going to apply preceding year basis. As we all know, if there is no changes in a partnership business, the profit of a partnership business is assessed to tax on preceding year basis. That means the profit of last year is going to be assessed to tax this year. So that is on preceding year basis. So let's look at questions. Let's look at questions. So let's look at question one. Question one first. Somebody should help us read.
The managing partner of Arinola Sukomi & Co., a firm of estate surveyors and valuers based in Lagos, has invited you to calculate the chargeable income of each of the firm's partners after the admission of Miriam in 2024. The information relating to the partnership are as follows. A. The firm makes up its accounts up to 31st December of each year. B. Extract the books of account for the year ended 31st December 2024 are listed below. Net profit for the year 1,380,000. Depreciation 450,000. Capital allowance for the year 366,300. Balancing allowance 72,500. Balancing charge 75,480. Profit on sales of fixed assets 77,500. Legal expenses for successfully defending one of the partners for professional misconduct, 14,000. Other information. The three partners are Arinola, Olasunkami, and Mofiefe.
Sorry. Excuse me. Don't let us start with this question. Let's start with
It's complex.
yes, this one is complex. We start with the one that is simple
Simple.
first so that we understand the basics. So we have to start from the simplest one. From the simplest one, we can move to the complex one. That is how it should be done. We can't start from the complex one. Okay, let's look at question 3.
Okay, sir. Can I read?
Yes.
Muiwa, Sheyi, and Akpan are partners in an accounting firm in Lagos, Music and Co., Chartered Accountants. The statement of profit or loss for the year ended 31st December 2022 is as shown below. Gross profit 65 million. Salaries and wages 5,100,000. Let me scroll, sir. Let me scroll up, sir. Office expenses 4 million. Provisions for bad debts 2 million. Depreciation 1.5 million. Repairs and maintenance 2.5 million. Donations 400,000. Training of staff 2 million. Medical expenses 1.2 million. Traveling expenses 500,000. Interest on loan granted by Sheyi 400,000. Interest on capital accounts Muyiwa 1.2 million. Sheyi 600,000. Akpan 250,000. Net profit for the year 43,350,000. Additional information is as follows. Donations was for laying of foundation of the new St. Peter's Church. The vehicles of Muyiwa's wife involved in an accident was repaired at a cost of 550,000, and this was included in repairs and maintenance. Medical expenses in the sum of 500,000 representing the cost of flying the principal partner's father-in-law abroad for treatments was funded by the partnership. Akpan made a voluntary contribution of 500,000 under the Pension Reform Act 2024 as amended. Let me scroll down. Capital allowances agreed with the tax authority was 4 million naira and partner sharing profit. Muyiwa ratio 6, Sheyi 4, and Akpan 2. You are required to compute A. The adjusted income of Music and Co. Chartered accountant for tax purposes. B. The chargeable income of each year, 6 marks. The next one, the tax payable by each of the partners, 8 marks. Thank you, sir.
So anything we want to do on partnership business, first, what do we need to compute first? What do we need to compute first? What do you think we should
Adjusted
compute first?
profits.
Adjusted profit. We need to this profit given to us, this net profit, we need to adjust it. We need to do what? Adjust it. Is the first thing. We need to adjust it so that we get adjusted profits. Looking at this, if we want to compute the adjusted profit, net profit first, Abi, Music and Co. Chartered Accountants, computation of adjusted profit. For which year of assessment? 2023 year of assessment. The account given to us, the year end is 2022. We normally assess partnership business to tax on preceding year basis.
Yeah,
That means profit of last year will be assessed to tax this year. Do you understand? So on preceding year basis. So that is for 2023 years of assessment. So we start with net what? Profit. This is net profit, Abi. We add back disallowable expenses. Let's go and look at the expenses one by one. Which one do you think is allowed? Which one do you think is disallowed? First, salaries and wages. Is it allowed or disallowed?
It's allowable expenses, but let's check the additional information.
Okay, thank you. Do we have information regarding to salaries and wages? Do we have?
No.
No. That means it's allowed, Abi?
Yes, sir.
Office expenses, allow or disallowed?
Allowable.
Is allowable.
Allowable. Subject
Yes,
to subject
sir.
that there's no additional information, Abi?
Yes, sir.
Yes, sir.
Provision for bad debt, allow or disallow?
Provision is general, specific, and
Which one is disallowed?
disallowed.
Why do we disallow it?
If it's not for specific, so it's disallowed.
If it's not stated either specific or general, what do we assume?
It's general.
We assume it's general. We assume it's general. And we need to do what?
Disallow.
Disallow. So provision for bad debt is disallowed. We have taken that.
Okay.
Do we understand? Depreciation, allow or disallow?
Disallowed.
Is disallowed.
Disallowed.
Repair and maintenance, allow or disallow?
Is allowed, but let's check additional information because there is a pair of father-in-law something.
We have checked.
Yes.
Look at it. There is one additional information.
Yes, sir.
Additional information too. Read it.
The vehicle of
disallowed.
One's wife involved in an accident was repaired at a cost of 550,000, and it was included in repairs and maintenance.
That means
So this
how much are we going to
Disallowed.
how much are we going to disallow in repair and maintenance?
we deduct the 550,000 from the
550,000 is what we are going to disallow. You can see
Yes.
repair and maintenance. I disallow 550,000.
550. Yeah.
Can you see that
yes,
in
sir.
the
Yes, sir.
solution? After repair and maintenance, donation, allow or disallow?
Disallowable expenses, depending on the additional information.
Yes.
Okay. Let's look at the additional information, whether we should allow it. Additional information one.
Donation
Is
was
disallowable, sir.
for
New St. Peter Church. It's a Catholic church.
Yes, it's for
It's for church now. It's for religious. It's not
yes,
for politics. It's supposed to be allowed.
It's allowed.
Eh?
Yes, sir.
It is disallowed, my sister. Don't mind me. It is disallowed.
It's not for the business now.
It's not
No,
for government
donations
organization.
is for government.
If it is government, public institution, it's allowed. And if you make donation to orphanage home,
Yeah,
it's
charitable
allowed.
organizations. Yes.
Charitable organization. But if you make donation to church or mosques,
The religion is not included.
it's not allowed.
Yes.
Do you understand?
Yes, sir.
It is not allowed. So now, after donation, training of staff, allow or disallow?
Allowable.
Hello?
It's allowable expenses, sir.
Hello?
Yes, sir.
Okay, you can hear me?
Yes, sir.
Yes, sir.
Medical expenses, allow or disallow? Let's check
It's
additional
allowable
information.
depending on the additional information. Yeah.
One of the additional information, see. Medical expenses
It's disallowable, sir.
represent a cost of what? Of flying principal partner, father-in-law to where?
To abroad.
Abroad.
So this one, 500,000, is going to be what?
Disallowed.
Disallowable.
Disallowed. So that means now traveling expenses, allow or disallow?
Allowable, sir.
It is allowed. Interest on loan granted by Sheyi. One of the partner, his name is Sheyi, he give the business a loan. They now charge interest on the business. Is it allowed or disallowed?
It's allowed.
It's allowed.
It is
It's
allowed.
allowed.
In this partnership business, it's allowed. If one of the partner give a partnership business a loan, if they charge interest, it's allowed. Interest on capital, on the capital contributed by the partners, partnership business is paying them interest. Is it allowed or disallowed?
It's allowed. Allowable
It's
expenses.
allowed.
It is allowed. So don't go and say, it's disallowed. It's allowed. It is allowed. Now we have done with that. We add back disallowable expenses. Our net profit is 43,350,000. And we add back what? Disallowable expenses. If we add back disallowable expenses to this net profit, how much shall we get? How much do we get?
48,300.
48,300,000. We now
300.
less capital allowance. We less what?
Capital allowance.
The balance remaining is the shared profit. Is the profit that we shared, that will be shared among the partner. What is the profit sharing ratio?
6:4:2.
That means Sheyi will take 6/12. Abi? Muiwa will take 6/12. Sheyi 4/12. And Akpan 2/12. So once he share this profit, Muiwa profit will be 22,150,000. Sheyi profit will be 14,766,667. Why Akpan profit is going to be what? 7,383,333.
So why are we dividing it by 12?
The total amount. The total amount. 6 plus 4
That
plus
total, see, 6 plus 4 plus 2.
10. Okay. 12. Okay.
So do you understand how we share this profit? 6/12 times 44,300,000. You will get 22,150,000.
22,150. Okay.
4/12 for Sheyi times 44,300,000. You will get what?
14,766.
14,766,667.
Yeah. And so on like that. Now, we are done with adjusted profit. Second part of the question said, compute the chargeable income of each partner. Chargeable income of each partner means what are the income of the partner that it will be subjected to tax. Like I said, what kind of tax the partner will pay? What kind of tax?
Interest on loan, interest capital.
Yes. What type of tax the partner will pay?
Personal income tax.
Personal income tax. What are the income of a partner that is subjected to tax? Interest on what?
Interest on capital, interest on loan. Salaries.
So you ask yourself, in the expenses, one of the partner collect what? Interest on what?
On loan.
On loan. That one is going to be income to him. Let's go and compute the chargeable income. Computation of chargeable income. Now, in my own solution now, I did question B and 3. I combined it together. B and 3, B and C. Question B and C was combined together. So if I want to compute the chargeable income, first, one of the partner earn interest on loan. Who earn it? You write, if you want to compute the chargeable income, you write the name of the partner first. Sheyi, Muiwa, Sheyi, and what? Akpan. You write it. Now, what are the income derived by this partner from the partnership business? They share profit, Abi?
Yes, sir.
That profit share is an earned income. That profit share is what?
Earned income.
Ending.
Earned income. Miwa, 22 million 150. Sheyi, 14 million 766 667. Why Akpan? 7 million 383 333. Interest on capital. The partnership business pay them capital, Abi? They pay them interest on capital, Abi?
Yes, sir.
Yes, sir.
For Miwa, 1.2. For Sheyi, 600.
600.
For the other man,
250,000.
Akpan 250.
250. That is what? Is still part of and what?
Income.
Income. The only on earned income we have, interest on what?
Loan.
On loan. It's an unearned income to the partnership, to the partner. At the end of the day, you total the income of the partner together. The total of Sheyi Muiwa income is 23 million 350. Why the total of Sheyi income 15 million 766 667. The total of Akpan income is 7 million 633 333. After you get your total income, like we did in our personal income tax, after we get total income, what do we normally minus? We normally minus tax exempt, Abi?
Yes, sir.
Tax exempt. Do you still remember?
Yes, sir.
In this question, does any of the partner have tax exempt?
Let's
what are the
check.
examples of tax exempt?
The
NHS,
NHIS,
life assurance, and what? Pension. So does any of the partner have tax exempt?
Yes.
Who has a tax exempt?
ICAN.
How much?
500,000.
500,000.
500,000.
Okay. So you less it. Once you less tax exempt, you get what?
Gross income.
Hello, can you hear me?
Yes, sir.
Welcome back, sir. It's like the nature tree
Okay.
out.
Oh, thank you. So after we get our gross income, we can now less tax relief. We are going to less tax relief. That is consolidated tax relief, consolidated relief allowance. The way we normally compute our consolidated relief allowance, higher of 200,000 or 1% of gross income. For Muiwa, 1% of gross income, look at his gross income, 23,350,000. 1% of it is what?
233,500.
Is it higher than 200,000?
Yes, sir.
That means we are going to take that 1%. You can see that is the one I take. Can you see the highlight? The
Yes,
one
sir.
I highlighted. For the other man, Sheyi, 1% of his gross income is how much?
157,666.67.
How much am I going to take?
200,000.
200,000.
Good. For the other man, Akpan, 1% of his gross income.
That's 71,333.33.
200,000.
How much am I going to take?
Pick 200.
200,000.
200,000. Now, plus 20% of gross income. 20% of 23,350,000. 20%
Yes,
of
sir.
15,766,667. 20% of 1,000,000, 7,133,000. We less them, we get chargeable income. So the chargeable income for Miwa, 18,680,000. We now compute the tax liability for each of them. First 300,000 at 7%. It applied to 3 of them. 21,000, 21,000, 21,000. Because they have the chargeable income is more. Shabi? Do you understand? Hello?
Yes, sir, we are together.
Second 300,000 at 11%. It will apply to 3 of them. Next 500,000 at how many percent? At 15%. 75, 75, 75. It will apply to 3 of them.
Sir. Hello, sir.
Yes, I can hear you.
This consolidated relief allowance.
Yeah.
After getting the first part, this 233,500.
Yes.
We are to add the 20% of the gross income, which is this
Yes.
4,670,000.
Yes.
If you take it out from 23,350,000, I did not get this 18,680,000, sir.
This 23,350,000 minus 233,500, Abi?
Yes, sir.
Minus 4,670,000.
I got 18,446,500.
How come?
I think that's the same thing I got. I think that's the same thing I got.
18,400,000 and what?
40,000.
46,500.
Let me check. Let me check the Excel. Let me check the Excel. Oh, I understand what happened. Let me show you the Excel. You will see. That is good to confirm something. Look at the Excel. Can you see the Excel now?
Yes,
Hello?
sir. Yes, sir.
If you see the Excel, you can see my when I want to add the chargeable income, you can see the cursor. It did not
Yes, sir.
pick this.
The 20 oh, the area of
It did not pick the
24.
233,500.
Yeah.
So I have to
Yes.
readjust
Not
it.
deducted. Yes. It
So
is
it has been
affected by
adjusted.
EC.
Yes. I will share it back. Don't worry. It has been corrected. Hello? Are you still
Okay,
with me?
sir. Yes, sir.
Yes, sir.
So the chargeable income for Cheyi, 18,446,500. Now, let's go to tax liability. First 300,000 at how many percent? 7%. Second 300,000 at 11%. Next 500,000 at 15%. Next 500,000 at 19%. Abi?
Yes, sir.
So the next thing, next 1.6 at how many percent? At
21%.
21%. So that is that. Now, what you do for Miwa, after you remove 500, 300, 300, 500, 500, and 1.6, you know the total is 3.2, Abi?
Yes,
Yes,
sir.
sir.
You will now remove it from his chargeable income. You remove it from 18,446,500, Abi?
Yes, sir.
What will be the balance? If you remove it, the balance is going to be at 24%. Do you understand?
Yes, sir.
Likewise, too, for Sheyi, 12,413,333. You remove 3.2. The balance will be at 24%. Likewise, too, for the other man, Akpan, 5,506,667. If you remove 3.2, the balance will be at what percentage? 24%. 553, 600. So that means the total tax due for Miwa is 4,219,160. The total tax due for Sheyi, 2,777,200. The total tax due for ICAN is what? 1,113,600.
Sir,
Do
if we
you
solve it,
understand?
yes, sir. In
So,
exam, if we solve
yeah,
it like this, the way you combined it now, to get the chargeable income and the tax liability, will it be
you have to
acceptable?
combine it in exam. You have to combine it. You don't need to do it separate.
Okay, sir.
Not reduce our
Yes.
mark.
It will not reduce your mark. It will not reduce your mark. So see, this is where the chargeable income stop. Abi, this place I highlighted. This is where B part of the question stop. C start from here. Tax liability. It will not reduce your mark. So let's look at question 2. Question 2. Question 2. Oh yeah, question 2.
Obi Consults is a civil engineering consulting firm of many years. The founding partners are Bibi, Ose, and Fowora. The financial year end of the firm is December 31st each year. The following information was extracted from the partnership's financial statement records for the year ended 31 December 2020. Net profit for the year 21,575,000. Provision for depreciation 13,250,000. Fine paid in respect of traffic offence committed by the principal partner's son while driving his father to catch up a flight to Abuja for a business transaction of 25,000. Donations to politician in business 150,000. Donation to National Library Board of Nigeria 165,000. Profit from sale of excavator 1,600,000. Capital allowance 6,575,000. Balancing allowance 677,000. Balancing charge 1,350,000. The following additional information was provided. Profit sharing ratio as agreed. BB 1/2, Kose 1/4, Kofowora 1/4. BB and Fowora are both entitled to interest of 5% per annum on loan of 10,500,000 each introduced to the firm. Fowora's loan was refunded in full on the day of his retirement. Salaries paid to the partners were BB 10,800,000, Kose 8,250,000, Fowora 8,250,000. On July 31st, 2020, Fowora, who is the eldest of the partners, retired at the mandatory age of 60 years. In order to fill the vacuum created by Fowora's retirement, Joyce was admitted as a new partner on August 1, based on an annual salary of 8,250,000. JC is also entitled to 5% interest per annum, having introduced a fresh loan of 7 million on August 1, 2020. The profit sharing after JC's admission are as follows. BB 1/2, Kose 7/20, JC 3/20. Fowora has no further income within 6 months after his retirement, but a sum of 900,000 which was paid towards his annual vacation was included in the partnership's expenses for the year. The tax authority agreed that the business should be treated as ongoing, such that commencement or cessation rules will not apply. You are required to compute the adjusted accessible income of the partnership. Determine the share of profits among the partners. Show relevant working for prorated salaries and interest on loan of the affected partners, assuming simple interest. Yes, sir.
Okay, thank you. The last part of the question.
Compute the accessible income of each partners.
Okay. Accessible income of each partner means total income. Total what? Hello, can you hear me?
Yes, sir. Total income or chargeable
So,
income.
yes. No. Total income is different from chargeable income. Don't misquote me.
Okay.
Total income before you let tax exempt. That is the accessible income. Do you understand me?
Okay, sir.
Eh?
Yes, sir.
You
So I
know,
didn't
n
hear that.
income plus on n income is what?
Total income.
That is where they want us to stop. They are not asking us for tax liability. They are not asking us for chargeable income. But if you want to tell the examiner that you know more than the examiner, you can go further. Is it not so? Eh? So, first thing we need to do, let's compute the adjusted profit. How do we compute the adjusted profit? We know if we want to compute adjusted profit, we need to have what? Net what?
Net profit for the year.
Net profit. We add back what?
Reliable expenses.
The salariable expenses. So
Divided
computation of adjusted profit. We need to compute the adjusted profit. In this question, what is our net profit?
21,575,000.
That is our net profit. Add the salariable expenses. What are the salariable expenses?
Provision for depreciation.
Number one,
depreciation.
we add it back. It's disallowed. This number 3 information call.
It's disallowed too.
It should be allowed
Yes.
though for business transaction.
It's
No.
disallowed. Any traffic
Disallowed.
Oh.
is disallowed.
Any
Traffic
fine,
offense.
either for business or
Okay.
this, is
It's
disallowed. We add it
true.
back. So donation, number 4, to politician in business.
Disallowed.
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 Donation to National Library.
Allowed.
Allowed.
Profit on sale of excavator.
Capital gain.
Eh?
That will be on capital gain.
How do we treat profit on scale of excavator? They have added to the net profit now. How do we treat it?
We remove it from the
Remove
net
it.
profit.
As what? It's called what?
Disallowed.
Non-taxable income.
Non-taxable income. Thank you. It is non-taxable income. Non-taxable income. So net profit 21,575,000. Add the salariable expenses. Provision for depreciation, fine paid, donation to politician, we add it back. We less what? Non-taxable income. Profit on sale of excavator, 1.6. At the end of the day, our adjusted profit, we are going to get 33,400,000. Now, after getting adjusted profit, before we can say this adjusted profit will be subjected to tax, what do we normally minus? From adjusted profit, before we can assess it to tax, what do we normally minus? Capital what?
Capital allowance.
Capital allowance. Now, let me show you these three elements. They are brothers and sisters. These three ones that are yellow, they are what? Brothers and sisters. The same procedure applied to them. But balancing charge, we add it back to your adjusted profit. You less capital allowance. You less balancing allowance. Have we started capital allowance computation? My colleague,
Yes,
have
sir.
you started taking your capital allowance?
Yes, sir. We've done it.
You have add of balancing allowance, have you?
Yes, sir.
You have add of balancing charge.
Yes.
So we add balancing charge to the profit, to the adjusted profit, have you?
Yes.
Do you understand? And we less what? We less capital allowance, we also less balancing allowance. So if we go back to this, our net profit, this is our adjusted profit. If we go back to this, our adjusted profit, add balancing charge to the adjusted profit. We less what? Balancing allowance first. We also less capital what? Allowance. Can you see how I less them? Hello?
Yes, sir.
So the remaining profit remaining is the profit that will be shared. Is the profit that will be shared. This is the remaining profit. 27 million 463 27 million 463,000. That is the remaining profit that will be shared. So how do we share the profit? That one will take us to requirement 2. Determine the share of profit among the partners. We need to determine the share of profit among the partners. That is what the requirement 2 is talking about. How do we share the profit? Now, how many partners do we have? How many partners do we have? How many partners do we have in this question?
You have 3 partners.
First of all, we have 3 partners, BC and what? BB, Kose and what?
Fowora.
But as time is going on, during the year, one of them resigned and another person joined them. Who resigned? Who retired?
Fowora retired.
Before.
Fowora retired. Abi?
Yes, sir.
That means for that year, 2020, how many months Fowora work? How many months?
7 months.
7 months. Out of 12 months, Fowora work for how many months?
7
7
months.
months.
That means Fowora cannot take profit for 12 months. He will take profit for 7 months. Look at this again. In order to feel, somebody help me read this. Yeah,
In order to fill the
Another
vacuum created by Fora retirement, JC was admitted as a new partner on August 1, 2020, based on an annual salary of 8,250,000.
JC was admitted on what? On which day?
August 1,
That means for that
2020.
2020, how many months JC worked?
5 months.
5 months. So this, let's go back to the solution. This share of profit that I highlighted, this profit that was highlighted, we need to divide it into two. First is share of profit before admission of JC. Before they admit JC. And second one is share of profit after they admit JC. Before they admit JC, how many months?
7 months.
7
7
months.
months. So that means this profit of 27,463, 7/12 times 27,463. That is the share of profit before their profit available pre-admission of JC. That one will give us what? It will give us
16,020,083 naira.
How many partners exist before they admit JC?
3 partners.
We share it based on the share profit ratio that they are using before they admit JC. Do you understand it?
Yes, sir.
The profit sharing ratio they are using before they admit JC, we share this amount. BB will take 1/2, which is 8,010,042. Kose will take 1/4, that is 4,005,021. While Fowora will take 1/what? 4, same 4,005,021. We have share profit before admission of JC. Another thing, share of profit post admission of JC. After they admit JC, what is the share of profit? How many months after they admit JC?
5 months.
5 months. 5/12 times the whole profit. How much is the whole profit that want to be shared?
27,463,000.
So 5/12 times 27,463,000. That one will give us how much? It will give us how much?
Eleven
It will give us,
million 442,917.
okay. Can you see that?
Yes, sir.
You know, we call it share of profit post admission of JC. Abi? How many partners will share this after admission of JC?
3 partners.
Which include JC too, Abi?
Yes,
Yes,
sir.
sir.
Based on the new profit sharing. After the admission of JC, the profit sharing ratio now changed. BB collect 1/2. 1/2 of 11,442,917. It will give us 5,721,458. Kose collect 7/20. That one will give us 4,005,021. Why JC collect what? 1 million. JC collect 1 million. JC collect 3/20 share of profit. That one will be what? 1,716,438. Do we understand? Do we understand?
Yes, sir.
So we have shared the profit based on requirement B. Requirement C, Roman figure 3, said show the relevant working for the prorated salary and interest on loan of the affected partner, assuming the simple interest. Show the relevant working for the prorated salary and interest on loan of the affected partner, assuming what? Simple interest. What that one means is that Fowora work for how many months?
7
Fowora,
months.
7 months.
7 months, yes, sir.
This partner, this is salary. This salary paid to Fowora is for 12 months.
Yes, sir.
He cannot collect 12 months salary. We are going to prorate it. 7 over what?
12.
Times 8,250,000. What do we get?
4,812,500.
That is 4 million. You can see the 4 million.
Yes, sir.
I'm supposed to do it separately as required in the question. So I will make the correction. I will do the as required. But I just put it direct in the solution in the question D. Roman figure 3. Show the relevant working for the prorated salary and interest on loan. Does Fowora give the business loan? Does Fowora give the business loan?
Yes, loan of 10,500,000.
And how many interest Fowora will be collecting?
5%.
5% of how much?
10,500,000.
This 5% is per annum. Since Fowora did not work for 12 months, we are going to quote it again. Do you understand?
Yes, sir.
That means 5% times 10,500,000 times 7
12.
over what?
7 over 12.
So how much do we get?
Times
306,250.
306,250. 306,250.
Okay, let me show you the interest on loan prorated for Fowora.
Okay.
Can we see it? I'm supposed
Yes,
to
sir.
do it separate how I get it because I'm using Excel. I do not do that. I have to do it. It's part of requirement.
They ask us to show workings.
Yes, show workings. We have to show it. Who did not work for 12 months again that we are going to prorate?
JC.
JC. Okay, JC, how much is the salary? JC was admitted on August 1st, 2020, based on annual salary of how much?
8,250,000.
So if you want to prorate the salary, how many months?
5 months.
5 over 12 times 8,250,000.
343,750.
343,750. So let me show you. I supposed to have do it separate as a workings as required by the examiner. I will do the correction. But I just take it direct to the question Roman figure 4, which is not good. I need to do it separate. It's 2 mark. That 2 mark is something. Can we
3
see it?
million. 4375.
Is it correct?
Yes, sir.
Interest on loan. Does JC give a business loan?
Yes.
Does JC introduce a loan to the business?
Yes.
How much
Yep.
loan?
7 million, 5% interest.
That is 5% times 7 million, Abby.
Yes.
Times how many months?
5 months.
5 divided by
5
12.
over 12.
That's 145,833.
833.
Interest on loan.
Yeah.
Can we see that? So we have done with Roman figure 3. Roman figure 4. What does Roman figure 4 is saying?
Compute accessible income of each partners.
Accessible income of each partner. I said accessible income is the same thing as what? Total income.
Total income.
But me, for better understanding, I compute the chargeable income, I compute the tax liability. This is where the examiner wants us to stop. But for students to understand very well, I can change it that maybe compute the tax liability. This is where the examiner wants us to stop. Do you understand me? This place I highlighted in green color is the accessible income. That is where the examiner wants us to stop. That is where the examiner wants us to stop. But for better understanding, I compute the chargeable income. Me, I compute the tax liability. In an exam, you have to stop where the examiner asks you to stop. Do you understand me?
Yes, sir.
Now, we want to compute the accessible income. That means we need to go and be looking for the income given to each of the partner from this partnership business. What are the income given to each of the partner from this partnership business? We can check them in the question one by one. First and foremost, that share of profit is number 1. Share of what? Share of what? Profit, Abi?
Share of profit. Yes, sir.
The share of profit, we put it as number 1 income. We have 2 share of profit. Number 1 is share of profit pre-admission of JC. Abi?
Yes, sir.
You can see for BB, 8 million, 10,042. For Kose, 4 million, 5,021. For Fora, 4 million, 5,021. No for JC. Another one, share of profit after admission of JC, which is post-admission of JC. 5 million for BB, 5,721,458. For Kose, 4,005,021. Y for JC, 1,716,438. What other income the partner collect from this partnership business? Apart from share of profit, they collected salary. How much is their salary? BB salary is 10,800,000. Abi? Kose
Yes.
salary is 8,250,000.
250.
So let's go to that. BB salary 10,800,000. Kose salary 8,250,000. Powora salary 4,312,500. Why JC salary 3,437,500. Do we understand how we get that?
Yes, sir.
Another thing, the partner that retire, they pay him annual vacation. Annual vacation means leave passage. It's an income to the partner. That partner that retire, they pay him annual what? That is a leave passage. It's an income. Can we see that?
Yes, sir.
It's an income. This 900 is called leave passage. It's an income to the partners. Leave passage. We are done with earned income. We are done with what? Earned income. The unearned income. The unearned income. What are the unearned income? Interest on loan. For BB, his own interest on loan is 525,000. We have get the one of Fora. We have get the one of JC. That means the total income for BB is 5,056,500. The total income for Kose is 16 million. The total income for Kose is what? 16,260,047. While the total income for Fora is 10,023,771. The one of JC, 5,029,000, 5,299,000. $5,299,771. So at the end of the day, this is where the examiner wants us to stop. But we can go further. You less tax exempt, you get gross income. You now less tax relief. If he lets your tax relief for them, you will get your chargeable income. You can now compute your tax liability as we did earlier. You will get your tax due. But examiner wants us to stop at assessable income, which is the total income. So, do we understand? Do we understand? Hello?
Yes, sir.
Yes, sir.
So, that is it on this question. So, by next week, we can look at one more question. We can go to another topic and look at one more question. Do we have any question?